Ford and GM don't have what it takes. And Tesla is just doing better than everybody. This piece just tells you that the company's more liquid, stronger than everybody with a better supply chain. It's an extraordinary piece. It's really well researched. And I think that the fact is that Tesla, people are in awe of Elon Musk out here. Somehow, this person, Elon Musk, has transcended all the problems that they see and is putting out something that everybody wants versus a lot of the companies out here.
In this video, UBS has released some epic new research on Tesla stock, upgraded the stock to a buy, has an $1,100 per share base case and a $1,663 per share price target in the bull case, which is a very, very long way from where we are today. So let's get into it. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks. Check out the links in the pinned comment below. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. So check out the links in the pinned comment below, and thanks for your support. First up, some quick comments from Jim Cramer over on CNBC discussing Tesla, their unassailable lead, and some of the key points from the new research note, and then we'll take a deep dive and look at UBS's research.
As we said, Tesla's up in the pre-market. Last month, the company tripled production at its Shanghai plant, sold more than 32,000 vehicles made in China. That's according to the country's Passenger Car Association.
Just a quick note, this is super impressive. Tesla China now back to full capacity according to latest reports and produced over 30,000 vehicles while slowly ramping up in the month of May. This is a massive achievement. Shout out to the Tesla Shanghai team. You guys and girls are absolutely slaying it.
Meantime, UBS does upgrade to buy, says the operational outlook is stronger than ever. Jim, they talk about record backlog, margin momentum, 2 new gigafactories, structural competitive edge in supply chain. They raised their earnings per share for the next 3 years by up to 40%.
Yeah, you really want to buy the stock after you read this. I think the headline says it all. Time to be bold. And I think that they're making a call that just says this thing has come down enough. The China news, I think, is it's a verification of what we've been hearing. But I think this innovative kind of just going away from the pack is once again a way to be able to say that Ford and GM don't have what it takes.
Fancy that. Ford and GM just don't have what it takes. It's almost like the world's starting to finally figure out what's been obvious to others for quite a while.
That's going to become questionable once GM really has the Hummer large-scale production.
I knew this was too good to be true. Cramer seems to think that once government motors can ramp up the Hummer EV, well, they'll prove all the doubters wrong. Oh boy, Jim.
I do believe that the Ford F-150 Lightning is a challenge. But yeah, I mean, Tesla is just doing better than everybody. It is a little aggravating because everybody else is really trying hard, but Tesla's just way ahead.
Aggravating is not the word I'd use. Then again, Jim Cramer and his charitable trust has a huge position in Ford, so I can understand why he might be a little aggravated. I think the correct word, however, would be embarrassing. It's embarrassing if you're Ford. It's embarrassing if you're Government Motors. It's embarrassing if you're Toyota. This tiny little irrelevant startup from Silicon Valley who don't even know how to make cars, next minute putting us all out of business, running circles around us, and demonstrating what happens as a company. If you don't try to disrupt yourself, somebody else will.
David, when I read what the analyst has to say, there is just a sense, Patrick Hummel, that China must somehow really favor these guys. There's just no way they could have such a ramp in China without the government saying we want Tesla to win.
This is correct, although again, this is something that's been quite obvious for quite some time. Let's run down the list of clear signs that the Chinese government was doing anything they possibly could, including favors and bending the rules, to get Tesla established in China. 1. The very first ever wholly foreign-owned automotive manufacturing plant in China. Prior to Tesla's entrance in China, automotive manufacturers needed a local Chinese partner who, yes, took a share of their profits. This was a very obvious sign that the Chinese government was willing to play ball with Tesla and really wanted the automaker in China. Then, of course, there was plenty of assistance, helping with construction, getting things done in record time. In addition, finance was arranged with some local Chinese lenders to actually construct the Shanghai Gigafactory with below market interest rates. Another special deal. And prior to the Gigafactory Shanghai being up and running, import duties and tariffs were waived for some of Tesla's vehicles. Clearly, China was willing to roll out the red carpet for Tesla. We've seen plenty of evidence of this.
That's an interesting point, Jim. I have no sense as to whether that's the case or not, but listen, what is it? 60,000 units have been lost due to the Shanghai lockdown. And then he goes on to say they expect Tesla to reach 1.4 million deliveries this year, resulting in a moderate 12% EPS cut versus prior forecasts. What caught my eye as well, though, is just the sort of the out-year targets. Almost 50 billion in EBIT in 2026. I mean, that is still 4 years out, but 50 billion in earnings before interest and taxes. Put a multiple on that, and you see sort of where you end up on a valuation. Obviously, their discounted cash flow model, they say, gets them back to $1,100 price target right now. So that gives you.
As I record this, $1,100 per share would represent 50% upside for Tesla stock from where we are today. And again, I want to emphasize this is A, price target for today, and B, their base case.
Yeah, this is an urgency. Carl, this is a piece which just is a clarion call. It's just saying, get in. And almost every single line item is much more positive than most people think. I think it's a gutsy call. If the interest rates weren't going higher, once again, I think this would be a fabulous call. You need to see rates lower to be able to make this thing so that the stock could be at 50 and not just 20.
Right. Jim, you mentioned some of the competition, but part of this note involves the supply chains that Tesla has locked up. Do we believe their rivals have done the same? And then the charging network, too, is going to be an education curve for some of these legacy OEMs, isn't it?
Yes, I think the others are still scrambling. I think the others, they are a couple of years behind him.
I definitely agree. Automotive manufacturers absolutely scrambling while simultaneously shitting the bed and wetting their pants, trying in vain to catch up to Tesla. But a couple of years behind, come on, Cramer, what planet are you on? Try half a decade or more behind. Depending on what you're talking about, some of these companies are a decade behind Tesla. And again, I want to emphasize, it's not how far behind these companies are. It's how fast they can move forward versus how fast Tesla continues to accelerate further away. Once again, good time to bring up the words unassailable lead.
But I think Ford does have a lot of be able to have what it takes for Lightning, but not to meet the demand at all. I think that the demand far exceeds the supply. Whereas with Tesla, look, every time they put out a car, it sells. And this piece just tells you that the company's more liquid, stronger than everybody with a better supply chain. It's an extraordinary piece. It's really well researched. And I think that the fact is that Tesla, people are in awe of Elon Musk out here. They are not talking about what's going on with Twitter. David, they don't care about Twitter. They care about the fact that somehow this person, Elon Musk, has transcended all the problems that they see and is putting out something that everybody wants versus a lot of the companies out here.
All fair points, but of course, nothing new here. We all know Elon Musk is one of a kind, is incredibly capable, talented, and most importantly, able to execute like no other. Let's run through some highlights from the latest UBS note. Title, Time to be bold, upgrade to buy. Although, let's be honest here, an $1,100 per share price target for Tesla stock, hardly bold. It's just that most other Wall Street analysts covering Tesla stock are gigantic pussies. No nuts, no vision, no understanding of the future, and therefore they're extremely conservative. So yes, this is bold for Wall Street, but I don't really think $1,100 per share in a buy on Tesla stock when it's in the $700 range is bold at all. It's obvious. Anyway, let's read on. Tesla's future is brighter than ever. We upgrade Tesla to buy from neutral with an unchanged $1,100 per share price target. Tesla is down around 35% year to date in line with other tech stocks, but we believe the operational outlook is stronger than ever before thanks to 1. Record high order backlog and 2 new gigafactories ramping up. 2. Margin momentum. After the Q2 dip, auto gross margin should structurally exceed 30%. 3. A structural competitive edge in key supply chains, resulting in superior growth and profitability. Blah blah, we raise earnings per share for the next 3 years by up to 40%, resulting in $28 in EPS in 2025. We expect Tesla's vertical integration in semiconductors, software, and battery to result in superior absolute growth and profitability in the years ahead. No shit, Sherlock. Integration represents a strong competitive edge in an environment of structurally tight supply chains. Bingo. It's important to control your destiny. Batteries are the next industry-wide bottleneck in our view. Duh. Tesla can outgrow peers with a combination of in-house cell capacity, its lead versus global competitors in using LFP cells, which are more economical, and its high share of directly sourced battery commodities, lithium above all. With a stable, dominant global battery electric vehicle market share of 20%, Tesla, we believe, is best positioned to become one of the top 3 global car makers by 2030. Spoiler alert, UBS, they will be the top automotive manufacturer by 2030, but even if they fall dramatically short of their goal of 20 million vehicles produced in 2030, they'll still be number 1, because the likes of VW and Toyota, some of the world's largest automotive manufacturers today, will be lucky, and I mean lucky, to be selling a third, maybe a quarter of their current peak volumes. We're going to see a massive contraction in the global automotive market. Share price drivers, innovation pipeline, ramp up, and maybe some surprises. A few catalysts here. 1, Shanghai production is back to normal. 3, another AI day, possibly with news about FSD and the humanoid robot. Possibly with news, I mean, definitely with news about FSD and the humanoid robot, but anyway. And by the way, I don't think this is going to be a positive catalyst. I think most of the world's going to see this and go, oh, well, I don't understand. I'm going to sell Tesla stock. Steepening Berlin and Austin ramp-up curve, auto gross margins sustainably exceeding 30%, and the Cybertruck launch. Just a few of the key catalysts. Valuation. Attractive entry point for a solid high-growth business, $1,100 per share price target. On a PE basis, Tesla stock is now trading close to historic lows on a 2-year forward basis, despite the unimpaired growth outlook. Yeah, this is absolutely insane. I keep saying it. Bargain of the fucking century, in my opinion. And interestingly, just a very curious note here, some of UBS future projections here, we have a dividend yield from Tesla. That's right, a dividend predicted mid-decade 2026, 1.6% of net income. I certainly won't say no to that. And now onto a few key pivotal questions. Will Tesla meet the target of 50% growth in deliveries despite the Shanghai lockdown? Yes. If you want to pause the video, feel free. I'm not going to go through all this in detail, otherwise this video will be years long. Question: can Tesla continue to grow faster and more profitably in EVs than its global OEM peers? Yes. Again, nothing new here, but it's nice to hear this coming out of Wall Street. Question: is Tesla's innovation pipeline going to cement its technology lead? Yes. Again, feel free to pause the video if you want to read this in detail. Evidence for our bullish view on the fundamental outlook is based on the UBS Evidence Lab Global EV Consumer Survey, which underpins the strong preference of consumers for Tesla vehicles. More on this in a moment. We think shares reflect a less steep growth and margin trend curve for the coming quarters and years. We are 50% above consensus in 2025. Talk more about this as well. And here's a look: downside, base case, and upside scenarios. We can see an upside scenario of $1,663 per share, base case $1,100, representing 53% upside here, and an absurd downside scenario. I mean, honestly, in order to get a $325 per share stock price, you have to get so creative and ridiculous, it's absurd. And I'm not saying this as a Tesla fanboy, I'm just being honest here. Some people might look at this and go, oh, okay, yeah, so maybe the downside's about as likely as the upside scenario. Not a fucking chance. And here we can see some of the assumptions. In UBS's upside scenario, $1,663 per share for Tesla stock. We've got 2023 deliveries growth of just 53%, 2023 automotive margins, not including ZEV credits, of 34.7%, and spoiler alert, long-term Tesla's margins are marching steadily towards 40%. You can count on it. Quote: Tesla is the world's largest electric car company with around 20% share in the rapidly growing global market for battery electric vehicles. Tesla differentiates from the competition. Man, I hate the word. I mean, competition should really imply an ability to compete. So I don't really think competition is the right word for all the companies trying to make electric vehicles, because they're not competing. It's just embarrassing. But hey, that's a conversation for another video. Through a very high degree of vertical integration in mission critical areas such as semiconductors and electronics, batteries, and raw materials, as well as software, especially for full self-driving. Oh, is that all? On top, Tesla runs various growth initiatives, and this is really important, with lower visibility but potentially high value. This is a huge understatement. I recently saw a comparison, profit versus employees, for companies like Ford, Toyota, and Tesla. Tesla didn't look great on paper because they have a lot of employees, and this is what they're talking about. They have a lot of initiatives that are beneath the surface. It's like the iceberg. You only see the tip. You don't see what's happening underneath, with potentially insane future value. The biggest example of this, obviously, full self-driving, which eventually becomes AGI in Tesla's humanoid robot. This is not at all being priced in. Pivotal questions. Will Tesla meet the target of 50% growth in deliveries despite the Shanghai lockdown? Yes. With around 60,000 units lost due to the Shanghai lockdown, and I need to jump in here, this is way under. Let's do the math here. Tesla lost about 50,000 units of production in April and about 30,000 in May. We're already at least 80,000, and there may be a little bit of slowness fully ramping back up again. This is going to be closer to 85, 90,000 units lost, maybe even 100 than 60. But hey, it's something. They continue. We expect Tesla to reach 1.4 million deliveries in 2022, and I expect this is going to be embarrassingly under the mark. Still a massive achievement, even if Tesla did come at 1.4. But I think a million additional things would need to go wrong for this to play out. What we're looking at here is UBS's estimates for Shanghai Gigafactory quarterly production in hundreds of thousands of units. We've got a peak of 179 and then dipping due to the fascist lockdowns and so on, ramping back up and peaking around 230 units per year by the end of this year. An annualized rate of a little under 1 million units. Again, they're a little bit under here, but hey, better than most of Wall Street. Now we have some interesting comparisons. UBS estimates versus consensus. Again, pause the video if you want to look in detail here. Just a few key highlights. In 2023, UBS is about 18% above consensus for revenue from automotive sales. In 2024, 34% above consensus. UBS expecting $11.43 of EPS for 2022. This is probably a little on the downside, but not too far off the mark. 2023, $19 in EPS, which is 31% above the Wall Street consensus, aka the clown show. UBS EPS estimates in 2024 about 45% above the Wall Street consensus. For those wondering, my base case significantly above UBS's own estimates, and my bull case about $60 in EPS in 2024. Something to consider. Quote, we also factor in a drop in the auto gross margins excluding credits to 26% in Q2 after 30% in Q1, and a surge to around 30% in the second half of this year upon full utilization of Shanghai and progress in the ramp up of Berlin and Austin. Very important point. Totally agree. We'll probably see a short-term dip in auto margins, but then they'll absolutely moon. Both new locations are likely to set the bar higher in productivity and process innovation, e.g. gigacasting, structural battery, resulting in profitability close to the Shanghai benchmark plant, i.e. much better than Fremont, keeping in mind the cost in Shanghai much lower overall, lower labor costs, some lower parts costs, blah, blah, blah. I think they're right. Remember, every new generation of a gigafactory is an improvement and an iteration on the prior design. Tesla learns every time they build a factory, they implement everything they've learned to try to become even more efficient, productive, resourceful, and yes, profitable. We can see UBS quarterly automotive gross margin estimates for Tesla. Again, I think these are actually way too conservative. By the end of this decade, not even at 40%. In my opinion, by mid this decade, they'll be at or above 40%. And this is a fascinating chart. We're looking at Tesla retail price hikes versus commodity costs per car. Now, these are UBS estimates. The key quote here, Tesla's price hikes more than offset the commodity price increases. And we know this. Tesla's products have such insane wait times because they're so good, so compelling, and such great value. They've been forced to raise prices not just to compensate for material price changes, but also just to ensure that customers aren't putting orders and waiting in multiple years to take delivery. Very good problem to have. What we can see here over the last 2.5 years, the price of Tesla's Model 3 has increased by 9K on average, yet the commodity prices have only increased 3.8K over that same period of time. Tesla's Model Y demonstrating the absolutely, and I'm going to say it, completely fucking insane demand. Model Y price increases an average of $14,500, more than $10,000 above the actual commodity price increase. That extra 10 grand straight to the bottom line. Quote, superior supply chain positioning could make a big difference in the years ahead. This is a huge understatement. Probably the most important thing in the entire note. Battery cells and raw materials. We think access to battery cells at reasonable costs will become a key differentiator between OEMs in the years ahead. Tesla was among the first companies to realize that EV demand will potentially outpace supply. No shit, Sherlock. Again, we've covered this. I won't go into all the details, but hello, 4680 cell. I mean, even back in 2014, they announced the Nevada factory. Yeah, we're going to be aiming to produce 500,000 EVs by the end of the decade, 2020. Everyone laughed and thought that was impossible. It would never happen. Tesla was high and so on. And well, one, they got there, and two, they were aware from a very early point how much demand there would be for EVs. Didn't take a genius to figure this out. Yet Tesla was the only company who had the vision and took the necessary steps. Now everyone's scrambling, and yes, they are completely and utterly fucked. Tesla was the company locking in the long-term material supply contracts from every company that they needed. And now they have the credibility. When Tesla knocks on the door of a mining company, goes, hey guys, we need all the nickel you can possibly give us, and we'll give you a gigantic 10+ year contract at a reasonable price. Let's lock it in. The mining company says, oh, you're Tesla. Yeah, sure, no problems. Meanwhile, an EV startup that's likely to go bankrupt knocks on the same door of the same mining company, goes, yeah guys, we think we might need maybe some materials from you in the future. Could we get some, please? Of course, the mining company says, sure, you can pay 3 times as much as Tesla, and you can have a contract that lasts 1/10 of the time, because we don't know if you'll be in business, and we definitely know Tesla still will be. Another very important chart here. Global EV battery cell market by chemistry. Tesla's high LFP share has become a competitive edge to grow faster. Other global OEMs likely to follow. Now, for those that don't know, we won't get into the boring details, but in short, LFP batteries, they're a little bit more economical. You won't get as much range out of an equivalent sized battery pack, but if you're brilliant at engineering, if you can reduce mass from the vehicle, if you can thermally manage the battery well, and if you've got a very efficient powertrain and so on, which Tesla does, you can actually use these cheaper batteries in your mass market vehicles and still beat other companies on range and certainly on price. LFP battery chemistry now making up a significant portion of Tesla's overall products. They can get these batteries cheaper, means they can produce more vehicles for the same amount of money, means they're more affordable for customers and or more profitable for Tesla. We now have some UBS estimates here. Battery cell supply versus demand, global, not including China. Notice the high risk of deficit. This trough here from 22, 23, 24 into 25 and possibly beyond, this is a big fucking problem. Unless you're a company who knew ahead of time that you would need lots of batteries and materials. Tesla was thinking 1,000 steps ahead. They're going to be least affected by this. They've got the longest term supply contracts. They've got the lion's share of materials, their own in-house battery program. Meanwhile, you have companies like Government Motors, Ford, Volkswagen, Hyundai, Toyota, keep going on, blah, blah, blah. Many of whom didn't think that consumers would want to buy electric vehicles in the first place. So yeah, they're going to struggle a little bit. And see, this is the really important thing to understand, ladies and gentlemen. Pay very close attention. This gigantic deficit, you know what's happening at the exact same time? This is the point where consumers literally need to be dumb to buy ICE vehicles because EVs will be cheaper, sticker price, much cheaper to own and operate. They're safer, they perform better by default, blah, 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 blah. So at the same time, the consumers are going, buying an ICE vehicle, why would I do that? I'm not that dumb. The exact same time consumers stop buying ICE vehicles and ICE vehicle sales collapse, automotive manufacturers are going to be scrambling over far too few resources to actually make electric vehicles. This is a really bad problem, unless you're Tesla. Quote, how relevant could Tesla's lead in batteries be from a financial perspective? Spoiler alert, extremely. Simply put, an estimated $10 per kilowatt hour cost advantage in battery cells results in around $700 higher EBIT per car, or 150 basis points higher EBIT margin, all else equal. In other words, a shitload. And that's before Tesla's innovative structural battery design used for Model Y at Giga Austin, which has the potential to greatly reduce manufacturing complexity and cost by several $100s per car. This really matters. As we see here, Tesla's gross auto margin remains well ahead of competitors. Tesla in a league of their own up the top here. UBS expecting further improvement in Tesla's gross margins. That being said, I still think they're massively underestimating. So yes, this is bullish, but again, I think they're way off the mark. This will be revised up in the future. And the same thing with EBIT margin. Tesla's EBIT margin has already surpassed legacy OEMs. This is very important to understand. Tesla's already better at making money making vehicles than the extremely experienced legacy automotive manufacturers. The competition that was coming for Tesla that hasn't arrived. Here we're looking at global battery electric vehicle market share. Tesla, league of their own. Interestingly, number 2 here is actually a group. Chinese OEMs, in other words, all of them combined. Not even where Tesla's market share is globally. And here we are in absolute sales for global battery electric vehicle sales going out to 2025. Tesla, league of their own again. Chinese OEMs rightfully in second place when seen as a group. Fair as well. China's doing a lot of innovation in battery electric vehicles. And apart from Tesla, that's about it. This chart shows UBS estimates, battery electric vehicle sales and total sales by OEM 2021 versus 2025. The red diamonds 21. Green, 25. We can see very, very, very sharp growth. UBS expecting Tesla to be in a league of their own by the mid-decade. Over 3 million electric vehicles sold. VW in second place, around 2.5. Quote, Tesla's key global competitors keep suffering from execution issues, also known as small brain syndrome, at least relative to the brains at Tesla. VW struggles to secure chips and other parts for its planned steep EV curve and is facing severe delays in the development of its next-gen software stack. Fancy that. An automotive manufacturer knowing nothing about software, and that being a major problem for their EV plans. Who could have seen that coming? The delays on the software side have already delayed the launch of the new PPE luxury car platform by 1 year to the end of 2023. Now remember, such a steep curve for EV adoption, a delay of 1 year could be fatal, catastrophic to your company. What we're looking at here is EPS trend. This is UBS estimates, new versus old, new in red, old in blue. Again, it's trending in the right direction, but still they're way off the mark to the downside. These will get revised up over and over and over. We also have PE trend based on UBS estimates. Tesla PE plummeting from 74 to 45 to 33 to 27 by mid-decade. Again, this is probably going to be way under, but this also isn't accounting for things like Tesla Bot, AGI, Robotaxi, and so on. And now more of those pivotal questions. Is Tesla's innovation pipeline going to cement its technology lead? Yes. Some key quotes here. FSD remains the most scalable and profitable autonomous vehicle system for passenger cars, not included in our base case again. Their base case, $1,100 per share for Tesla stock right now. Substantial optionalities, like the humanoid robot. Again, this is a huge understatement. This thing is going to dwarf every other aspect of Tesla's business by at least one, if not two or three, maybe even 4+ orders of magnitude. I'm not kidding. What's priced in? We think the market still doesn't give much credit for Tesla's FSD timeline. We're also more conservative. And the planned dedicated robotaxi. Again, this is fair. Most people pie in the sky, that's never going to happen, or it's going to be 10, 15 years, let's ignore it. Again, this is huge potential upside that the market is not pricing in, which might explain why I'm still buying Tesla stock with every spare cent and still think it's the bargain of the fucking century. Innovation pipeline is busy and not fully priced in our view. Quick look at the Tesla innovation roadmap according to UBS. Some of the more important things on here, Cybertruck, yep, cool, we all know about that. The dedicated robotaxi, UBS expecting this to happen after 2025 with very high growth prospects and very high profitability. Well, duh. Full self-driving, UBS expecting after 2023, this makes a meaningful impact. Medium growth, profitability, very high, spot on. And amazingly, I am absolutely stunned. Research from Wall Street that actually includes the words humanoid robot, and not in the form of ridicule, but actual acknowledgement. Note, financial relevance, growth initially low but potentially high long term, and profitability initially low but potentially high long term. Huge understatements. We've been over this. Don't say I didn't warn you. Some of you fuckers are going to be watching these videos in 2042, looking back when I was saying Tesla bot's going to dwarf everything else in Tesla's business by orders of magnitude, thinking, that guy was high. Wait, oh, he was right. Again, imagine that. And now, as promised, some more discussion about UBS's consumer surveys. Brands known to make battery electric vehicles. Figure 17. Tesla, number 1 by miles. In China specifically, Tesla are actually 3rd place, beaten by BYD and XPeng, which makes sense. They are local battery electric manufacturers in China. It's reasonable to expect they'd have pretty good brand recognition in China. And now we're looking at electric vehicle brands considered to buy, as in consumers would consider buying from that brand. Tesla, league of their own. 41%. Second place BMW 27, third place Audi 26. And would this be a good time to remind everyone that Tesla doesn't pay for advertising, yet still consumers already know and want to buy Tesla vehicles globally? Yeah, let's not mention that. And now the big one. Top choice brand globally for electric vehicles. Tesla, league of their own, 23%. Second place is at 7%, third place at 6%. You guys can see visually. No contest. But remember, the competition is coming. Figure 21 here, top battery electric vehicle choice by brand in Germany. Quote, Tesla's showing signs of slowing momentum, but remember, this is before the Berlin factory has fully ramped up. In the UK, however, things trending in the opposite direction. In figure 22, Tesla trending up around 24%, second place 8%. What a joke. In the US, figure 23, Tesla at 35%, massive trend up. Why? Because their production is trending up. That's kind of how things will work. BMW, second place at 10%. Remember, Tesla 35, BMW 10. What a joke. And top battery electric vehicle choice by brand in China. Tesla's still leading, but losing edge. We can see here Tesla 18%, BYD 15%. Remember, massive expansion in Shanghai. So let's see how this plays out. Valuation. Tesla stock is cheap relative to its own history, while growth perspectives are better than ever before. Tesla shares are down around 35% year to date, mainly on shit that has nothing the fuck to do with Tesla. Sorry, I misread that. Hang on. Mainly on macro concerns and interest rates, while the EV demand curve has become even steeper and Tesla's lead versus the competition in managing key supply chains even more obvious. So again, to translate the Wall Street jargon here, like I said, Tesla stock has got smashed this year, not because of anything to do with Tesla, EV demand, EV adoption, nothing to do with Tesla, and everything to do with stuff that has nothing to do with Tesla. Does this make sense? And the answer obviously is no. Once again, I reiterate, Tesla in the $700 range today in mid-2022, bargain of the fucking century, in my opinion. People are going to be losing their minds in a few months' time, in my opinion, when Tesla stocks moves back to where it should have been, going, was it really $700 in June 2022? Really? No. Don't say I didn't warn you. Quote, it's worth highlighting that projected 2025 EPS can be reached 1, mostly with existing product and the known upcoming Cybertruck, and 2, the known production footprint in Fremont, Shanghai, Austin, and Berlin, including the expansion underway to 3.6 million units of annual capacity by 2024. Further growth after 2025 will likely be fueled by a lower price car, $25,000 Tesla, higher FSD penetration once the software stack fully lives up to the promise, and the portfolio of other optionalities. Dedicated robotaxi, oh my god, they said it again, Optimus humanoid robot, semi, energy storage, etc. I just like to see the word Optimus bot even being acknowledged in these comments. I love it. Figure 26, Tesla deliveries by product. As we see, UBS expecting Tesla to fall short of 10 million vehicles delivered in 2031, well under half Tesla's publicly stated goal. So UBS estimates here all based on Tesla getting to less than 10 million units by the end of the decade. I'm here to tell you, ladies and gentlemen, unless asteroids hit every single one of Tesla's gigafactories by mid-decade or so, even in the worst case scenario, and I mean worst case scenario, World War III type shit, Tesla's still going to exceed UBS estimates in their base case. And over the medium term, Tesla production capacity trend in hundreds of thousands of units. UBS estimating by end of 2024, Tesla will be at an annualized rate of about 3.6 million units. I actually think these are fairly reasonable. With a lot more visibility over the next couple of years, UBS close to on the money here. Obviously, there's plenty of potential upside too, but I think this is a good general conservative estimate. Where UBS lose the plot, however, is after 2024, somehow deciding that the exponential growth curve will just suddenly run flat out of nowhere. Quote, as Tesla has become fully self-funding, there is very low risk of unexpected shareholder dilution. And this is very important, completely agree. In other words, Tesla won't need to go to the market again to raise money, to do shit. They've got enough money internally from their own operations, meaning they won't need to issue more stock, meaning shareholders will not get diluted. In fact, the reverse may actually end up becoming true. If Tesla begins share buybacks at some point in the future, shareholders, instead of suffering from dilution, will benefit from concentration. All future expansion projects can be financed by Tesla's balance sheet in our view, and the rising net cash balance will likely soon result in the strongest balance sheet in the global automotive industry. Correct. Therefore, higher interest rates and higher cost of equity only matter from a DCF, discounted cash flow valuation perspective, but are irrelevant for EPS and the capital structure of the company. Again, translation, the current shit in the macro environment, interest rates, nothing the to do with Tesla's business, profitability, EV adoption, etc. And a quick look, free cash flow, Tesla definition, and net debt to cash 2018 to 2026 UBS estimates. In short, trend to the moon. Where could we be wrong? Recession risk. Again, if you guys want to pause, have a read. I mean, with or without a recession, Tesla's going to keep executing. People have this idea, oh, recession, people won't be buying new vehicles. Yeah, fair point. They will be buying Teslas. These things aren't vehicles. They're a computer on wheels. I tell you what, a recession will absolutely fuck internal combustion engine vehicle sales. It'll be devastating for legacy OEMs. With or without a recession, minimal impact on Tesla. Really. Remember, their wait times are insane. They've been forced to raise prices ridiculously. Tesla has a lot of wiggle room. Other companies do not. And then, of course, you've got key man risk as well. Elon Musk remains the key person at Tesla, with all the risks associated with that. Further, his activities outside Tesla and contributions to public debates have the potential to affect the share price. Again, they shouldn't, but this is actually true. One recent example was the sale of Tesla shares to finance the planned acquisition of Twitter. The actions, social media posts, etc. are highly unpredictable. And yes, and as a result, they certainly can create some amazing buying opportunities, in my opinion. So I hope you guys and girls have enjoyed this deep dive into the latest UBS research on Tesla stock. I've got to give credit where it's due. They seem to get it better than many on Wall Street, but they're still way off the mark to the downside on just about everything. It's a start, but that's all it is. An $1,100 base case price target for Tesla stock right now, about 53% upside from where we are today. The bull case, $1,663 per share for Tesla stock, considerably more than a doubling from where we are today. And I think even this bull case is fairly conservative. And once again, I have to say, I'm as stunned as I am impressed to see research from Wall Street analysts on Tesla stock that makes mention of Tesla's humanoid robot. Admittedly, a little bit of uncertainty, but the very fact that it was even here, got to give some credit where it's due. A round of applause to UBS. Interestingly, my weighted average price target for Tesla stock, which per the name is the weighted average of each of my different scenarios and their probabilities, the bear case, the base case, the bull case, and the hyper bull case, is almost identical to UBS's bull case for Tesla stock in 2022. And on that note, if you'd like access to my Tesla stock price targets out over the next 10 years in the bear case, base case, bull case, and hyper bull case scenario, plus of course the weighted average price targets, which is really what you should think of as my base case price target. That's where I think things are most likely to land. You can join Patreon with the card in the corner or the link at the pinned comment. In addition, you'll gain access to well over 100 Q&A videos, loads of other exclusive content and perks. So, see you over on Patreon. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.